Hi everyone, welcome to this April client monthly update. I'm going to include some of these videos on a monthly basis in client newsletters just to try and talk about some of the things that is happening in the world of personal finance and ultimately to hopefully give you a bit of peace of mind to not be worrying about this stuff. So at the moment, it's pretty noisy out there. Lots going on with life and in primarily the drama in the Middle East and oil price volatility. It can make all this noise pretty unsettling, and you're maybe a bit worried about what this means for portfolios and long-term financial planning. But it's really important in times like these to remember that the volatility we're seeing is not in any way abnormal. And it is indeed part of the course for investing and understanding that this is just what happens when you're participating in global markets. Markets are heavily reactive to short-termism, and current prices will vary depending upon sentiment, whether the market is perceived highly or low or in a lower manner. And the reality is the underlying companies that you will be invested in within your portfolio, the fundamental economic attributes of those companies will in no way have changed. So the delivering growth over the long term, none of that has changed materially. All that's happened is short term, the volatility in the markets we're seeing is coming through and it's making people a bit anxious and causing a bit of unrest. But the only detriment to the long term is if you act at the moment and sell during times such as these when there's a little bit of volatility in markets. If you don't, then all that's happening is just paper losses. And as I'll show with you in a moment when I share my screen, is over the long term, the key detriment of long-term financial health is ultimately staying invested through the highs and the lows. So I've got some analysis here that I've read over the last month, which has been supplied by Dimensional. So Dimensional are a US fund manager, and they are a key makeup of the portfolios that I run for my clients. So Dimensional really value what they stand for. They match my investment views exactly. The time in the market far exceeds timing the market. And one of the best things you can do really is remain disciplined and remain investing throughout market declines. So we see here the average returns for the S&P 500 over the last 100 years is around about 10%. So that is the reward that diligent, disciplined investors can expect to receive over the long term. Now, naturally, some years will be higher, some years will be lower. Indeed, as high as 54% in one year back in the early 1900s, balanced with negativity of minus 43%. So we need to expect that some years there will be greater levels of volatility than others, but typically we can see this trend line here in yellow, which tells us that the average returns hover around about 10%. Now, within that 10% band, interestingly, if we were to look at the calendar year returns, whereby the return was broadly within that 10% average, it would only be 7 out of the last 100 years. So in 93 of those 100 years, we're typically going to see volatility that extends beyond the 10% average return that we have seen. And you can see that in the graph here. There is years where there's spikes, there's years when there's troughs in the evidence of returns, but the average is around about 10%. So when we're seeing volatility, this should reinforce that over long periods of time, this is very natural. Indeed, volatility is something that we expect. Now, reassuringly, as investors and participants in global markets, we've seen far more ups than downs. If you look at this graph, the blue boxes evidence years where there's been a calendar year return, which is positive, and in yellow, it evidences years where there's been a calendar year return that is negative. And you can see the graphs typically start to fall and taper away at the peripheries here, because in some years there's been drastic outperformance and in some years there's been drastic underperformance, but typically they congregate around the middle. And we can see that in more cases than not, there's a positive return, typically in 3 out of 4 years. In 75% of the time, we will see positive returns, provided you remain disciplined and in your investment seat during the years of market downturns. Now, what's interesting, mostly from my perspective as one of our money nerds, is that in nearly 3/4 of the down years, we saw that there was a positive rebound. So those people who sell during these downturns will typically lose their ability to recoup some of those losses by acting on their behavior rather than sound logic and what evidence has taught us over long periods of time. Most recently, if we look at 2022, we can see that stocks declined by around about 20% and rebounded the very next year by over 25%. Those investors who sold during 2022 will have lost their ability to partake in this market rebound. So what can we learn? A rally will typically follow a retreat. And if we look at evidenced years when there's been a 10% drop in markets, a 20% drop in markets, or even a 30% drop in markets, we can see that over a 1 year, 3 year, and 5 year period, we experience market rebounds. We experience positive growth coming back through in the value of your portfolio. And indeed, the average cumulative returns were higher than 50% after 5 years. We can see that here. And if we look at the middle section here, when we look at a 20% market drop, which is typically what we would consider to be evidencing a bear market where prices are depressed, we can see that over 1 year, it had rebounded by 18.8%, 3 years, 40.7%, and over 5 years, 67.1%. So remaining in your seat during the times of volatility has told us historically that is the best recipe for long-term investment success. And after 3 years, we can see stocks gained more than 40%. So if you remain in your seat during that 3-year window of a typical bear market, you can expect good levels of recovery in the value of your portfolio. So what can we learn from all of this? Well, patience is a virtue. The kind of noise that we're seeing in markets at the moment is not abnormal. Indeed, it is perfectly normal, perfectly reasonable to expect this level of volatility. And yes, there's been some years where the volatility is far outpacing the current volatility we're seeing. But it's important to remember during times like these, this is the reward you will receive in the long term by being disciplined now. And this is why stock markets exist, is they transfer rewards from the impatient to the patient. I really love that saying, and that is key above anything, is it matters less about what you're investing in and more about how you behave during the times of inevitable market decline. Inevitable market decline, because these things that we're seeing at the moment, again, is just the nature of investing. When you participate in financial markets, they will move depending on current rhetoric and current market sentiment. So if you're reading negative things in the news, yes, it can be unsettling, not just from a financial standpoint, but from a wider life standpoint at the moment. When it comes to your portfolio, tune out this noise, focus on the long term, and the most well-disciplined investors are those that will have the best long-term projections for their portfolios and ultimately will permit them the greatest ability to use their money and their wealth in a way which is suitable with their own life goals. If you act based on misinformation and emotion, it can really be damaging to the long-term growth prospects of your portfolio. And of course, that's what I'm here for as your financial planner. So I hope you found this helpful. If anything you'd like me to cover in future monthly newsletters, do let me know. I'll wrap up there. Enjoy the rest of your week and have a nice weekend. Bye for now.